I want to bring in Jason Thomas, Carlyle Head of Global Research and Managing Director. He's out with a recent report that says 5 questions to watch for 2020. And some of them include whether a trade deal will foster more engagement between the U.S. and China. We were just talking about that when it comes to earnings. And if Europe will embrace fiscal expansion, and how the Fed feels about inflation. Jason, thanks for joining us. Good
Thanks
to see you.
Thanks for having me.
So does the Fed feel good about inflation? How does the Fed feel about inflation?
Well, if we look back over the last decade, the price level in the U.S. is about 5% below where it would be if the Fed were able to hit its 2% inflation target. So I think the Fed is actually, there's a very clear bias towards rate cuts. Mm-hmm. I think the move in rates and the priced-in cuts is, of course, related to the fear of the virus and mm-hmm. hedging and the same dynamics that have put downward pressure on risk asset prices. But in general, even taking that aside, even if in 3 to 4 months everyone feels more comfortable about the viral outbreak and we're past that as far as a macro narrative, there is still going to be this downward bias in favor of rate cuts. And I think that that's something that is, again, related to this inflation undershoot, mm-hmm. the way it's been persistent. And the only way for the Fed to prove that it's truly symmetric when it comes to hitting its inflation target is to actually be not only cautious in terms of raising rates, but to actually proactively cut rates if inflation continues to undershoot.
Evan, what's your base case?
Yeah, I think that's right. I mean, in general, we don't see the Fed moving this year, and it's interesting that the market is really starting to price in a cut and even more than a cut.
Is that a Fed put? Is that the market saying, like, we still think there's a put here from the Fed?
Yeah, I think it's a few things. I think it's one, what Jason is talking about. They're doing this inflation framework review, and they really want to show the market we're serious about inflation expectations getting higher. I think two, it's downside risk protection against the virus outbreak mm-hmm, or other trade issues. And I think third, it's just we're still seeing a U.S. economy, U.S. economic data where consumers in good shape, but the rest of it is kind of mixed. So all of these things combined lead you to a Fed that is more likely to cut than hike. Hikes are a long way away, mm-hmm. that's for sure.
Well, also just looking at even the meeting in the next 2 days, like, there are risks now that weren't in the December meeting, right? You have a virus, you have Iran versus U.S., and then that bubbling up as well. Sort of the downside. I wonder if we're going to see more downside risk assessment in some capacity.
No, absolutely. And I think that what you've seen in asset prices is a recovery that is yet to be evident in the data. Mm-hmm. And so as we get deeper into the first quarter, it looks as though there's going to be some pretty significant downward pressure on China's GDP. That this could spill over more broadly. And I think the hoped for rebound because of the phase 1 deal may be pushed further into the year. So I think that's going to change perspectives. And I think, again, the downside risk, or at least a reassessment of the strength of the rebound, is something we could be talking about through the end of the first quarter.
And go ahead, Evan.
No, I was just going to say that we were excited coming into this year that we thought we had the potential for a much more vigorous mm-hmm. economic recovery mm-hmm. Than most. Everyone said, okay, we expect a recovery, but it's going to be very modest, muted, and the like. And we were positioned much more aggressively international than the U.S. because of that. Now you have this coronavirus, and that is complicating things. And as much as we saw some really nice manufacturing PMIs on Friday, especially out of Europe, you have this overhang here. We still think that the power of the global easing that you saw last year is, providing a really nice support from here. But I like the way that Jason put it. I think it's more delayed as opposed to derailed, this economic recovery.
Well, fair, because also if you think about the virus, at some point it'll be solved, and then you have to come in and kind of rebuild and rejigger everything. So to that point, and we talked about this earlier, the shift into value felt like a blip, or like a 3-month blip. And you had a great chart in this piece that you did that talked about just how expensive growth is over value, and that ties into the Europe, it ties into the EM story. Walk us through it.
Sure. So, one of the clearest empirical facts in finance over the last 83 years is this notion of a value premium. Buy what's cheap, hold on to it for a long period of time, and your portfolio will tend to outperform. The opposite has been the case over the last decade, where growth has really significantly outperformed. And the reason growth has outperformed is because people have been willing to pay progressively higher multiples for growth. And so at the end of last year, we had reached a point where the trailing multiples for the top quintile of growth stocks was now at all-time highs, about 80 times trailing earnings. And so we live in a world where investors are starved for growth. They see the downward pressure on expected returns, and they recognize the only way to actually hit those return targets is to invest in the fastest growing companies whose earnings growth can ultimately validate today's very high valuations. But one has to wonder if we've reached a point where it's, there's so much froth and so few companies can actually hit those embedded growth expectations that it makes for a market where there's really no margin for error.
Yeah, don't disagree. I think
reluctantly.
Yeah, I mean,
you're like, I really need the value story.
I would like the value story to play out. It would certainly help with tilts towards Europe and Japan. But I think what we need in the end is a more vigorous economic recovery. Full stop. We need bond yields to be going up. We need people to be feeling better about the world. Right now, they don't. I think we will still get there. I think we're kind of trapped in this late cycle mentality, but ultimately, I think we'll end up seeing that good bounce in activity, and that's going to underpin the value story. It's just waiting for Godot at this point.
And the other part of that is, though, is it possible to get some kind of economic recovery yet still have yields trade between like 1.5% and I'll just call it like 2.5% and still have growth outperform because you're just in like a new low neutral environment?
No, that is my expectation. Right now, we have this cyclical downward pressure that's, again, related to virus scare. It's also related to the change in the Fed's policy framework, also ECB rethinking its framework. So there's some cyclical downward pressure. But from a secular perspective, what we used to think of as a neutral 10-year yield of 4.5% to even 5% is now, I think, really in that 2% range. So now you're going to have yields cycle around 2%, almost irrespective of where we are in growth in the cycle. Well,
and then to your point, like, how do you get that real shift into value if the neutral rate's going to come down or it's lower than we may think, and you're just going to have like a 1.5% to 2.5% yield?
I think to really get the big shift that everyone's looking for, value from growth, it's going to have to be really aggressive fiscal policy, which we are also still waiting for. You're seeing it in a few places, but it may be to get a secular shift. It may be we have to wait until after the next recession. Monetary policy won't have enough room to cut. Fiscal policy will, elected officials will panic and they will let it rip on fiscal. Then you could see value really start to outperform growth.
Which is another one of your themes, which is will Germany embrace fiscal? But that was a good point in that maybe we have to wait until the next recession, things get really bad, and the central banks can't do anything. I haven't heard that one before.
We could. It's important to note that it's not simply debt or debt to GDP ratios. It's also what you pay to service your debt. And when you have interest rates that are at zero or negative territory, and you expect that they're going to remain there indefinitely, the whole fiscal arithmetic has changed so dramatically from 92 when they signed the Maastricht Treaty. And so I think that once this gets incorporated into thinking, there has to be some fiscal expansion in Europe, and not just in Germany, but I think is the Eurozone as a whole. And of course, the UK now, as of January 31st, outside the EU, I think there's going to be about a 1 to 1.5% fiscal expansion this year. And I think that could set a stage for perhaps the Eurozone following its lead.
If that scenario plays out, in addition to yours, like things also have to get worse, so we see central banks can't do anything, does your trade and portfolio allocation still work, or are you just maybe not as aggressive?
Yeah, I think that's what it is that because of the cyclical pickup that we expect, even without a major fiscal impulse, we think value over growth is a trade that will work, but it's more trade than investment. For it to become a big investment, that probably takes much more aggressive fiscal, and that might be after the next recession.